Hello and welcome to another lesson to introduction to the option market. In this case, we are going to speak about pricing of the options. We are going to understand how options are priced and learn how we can get the best returns for the options we are going to enter. We are going to see the price components, the factors that affect the price, and how to planify our trade. Let's see the components. So in this case, the main factors that are going to determine the price, the premium that we are going to pay for an option is going to be the stock price, the strike price, expiration time, interest rate, dividends, and volatility. However, honestly, you can kind of ignore the interest rates in the dividends because they play a very small part into it, and instead we are going to have the volatility. Also, I want you to understand that this is a variable that we know. This we know, this we also know, we also know. The only thing that we don't know is volatility. So from volatility is where we are going to gain our edge later on. In the advanced lesson, I'm going to speak more about it. So how are the valuation of the option? And what factors affect the supply and demand for the options? Imagine, for example, the stock owners, they get angry or nervous. So they start to buy options for protection or speculation. By doing this, they increase the pressure and raise the volatility, and because they raised the implied volatility, the result is going to be in more expensive premiums. So because we are going to have a higher expected move in the security and it's going to be a bigger demand for these contracts, so we are going to have bigger implied volatility levels. So yeah. The implied volatility can be used as a measure for an option relative value. The supply and demand for option contracts affects volatility, among other stuff. But yeah, the base is going to be the supply and demand, which is going to be caused by different factors like announcements, Fed decisions, politicals, earnings, and fundamentals, macro factors, and so on. At the same time, it can be in the reverse. So imagine, for example, we would have a rising market, which improves the outlook. We are going to sell options for the income, and it's going to be much bigger pressures on the selling. So by doing this, we are going to lower the IV levels. And when we are going to lower the IV levels, we are going to have less expensive premiums because it's going to be a lower demand for the options, and we are going to have a lower expected move in the security. As you may remember previously, we had the intrinsic value and extrinsic value. Let's explain this a little bit more with an example. So you see, let's take for example SPA again. What does it mean? Intrinsic value and extrinsic value. The current price of SPI is 454.70, 80, and so on. Everything above 454, in this case for a call, like for example 455, 456, 457, all of these, they can be considered to have, So everything below this price of 455, 454, 43, 41, these strike points, they can be considered to have a value. Why do they have a value? Because they are not worthless. Like this one, 450, right now, even though it's for May, let's look for the April 6th, for example, in 2 days. So all of these, this one right now, or 450, if we go back to the presentation, you know, it's in the money. Why it's in the money? Because the strike price that we have of 450, it's already hit, because the current price is 455. So because we are in this position right now, we can consider that our trade is in the money and has a intrinsic value. If, for example, we would choose a call price for 456 and upwards, those values are going to be out of the money and they would have no intrinsic value. And in this case, the intrinsic value is going to come from here, from the strike price that we have and the current price which we are. The intrinsic value is going to come from other places, like the company, assets, earnings, you know, and so on. So yeah, the factors that affect the price are going to be the stock price, the expirational, and the volatility. And so yeah, based on the price that is a stock, like for example, you know, we'll have much bigger prices for the option than a stock with a lower price. Like for example, you will take Amazon and you will take, for example, I don't know, Boeing, to say like this. But yeah. And then in the end, we are going to be able to measure this movement through the Greeks. And how these movements as well are going to affect the option contract price. This is actually where it's our edge, but I'm going to explain it more. I'm going to make a small resume now, but I will explain more in the advanced lesson. The most important factor or element, I would say, from trading the options is going to be the delta. The delta can be used to tell you how much your option contract's price will change based on a dollar move. Also, it can give you a share equivalency or an approximation of probability that the option contract will expire in or out of the money. So we can see, for example, in this case, like if you will take 450, we can see that we have a delta of 0.833. This delta is going to be able to go from 0 to 1 in case of calls, or from -1 to 0 in case of puts. So in this case, you can calculate it as an 83% chance that our call of 450 strike price is going to end up in profit. Or better said, it's going to end up above the strike price. That's better said. So we have an 83% chance that our asset is going to finish above 450. And for example, if we will go here, we have 23%, 24% chance that our price is going to end up above 458, taking into account that the current price is 454, 455. So more or less, yeah. Then for example, from the delta, you can see we would have an 83% chance, which it's always going to be the reverse of the other value. So we can see we would have an 83% chance as a put that the price is going to be below 459, or we have only 13% chance that the price is going to be below 449. So yeah, you can see that they are reverse value one for the other. Now as well, for the calls and for the short, it's going to be different than for the buyer. Like for example, you have 87% chance that the strike price is going to be above 449 as a caller, but you have one minus this, which is going to be 15% chance that the price is going to be below 449, which you would require if you would be the seller of a call option. And the same here, you would have 14% chance that the price is going to be below 449, but you would have one minus 15%, which is going to be 85% chance that the price is going to be above 449 if you would be a put seller. So yeah, I hope this makes sense. So as I said, delta, like for example, a long call, yeah, because the main value actually is in the price of the credit. So let's say we have a 0.5 delta. At the same time, it means that after each $1 value of the strike, like where for example here, you can see that the option, for example, right now cost $5. Let's take another one, which is going to be easier for us to calculate. We can see, for example, that this one, it has a delta almost of 1, so we can calculate it as 1. So the strike, the price of this option is $20 right now, 20.50, sorry. If the current price 455, it will be 456. In this case, the price of this option is going to be 21.67, and so on. You can see that all of them, they have a difference of 1. Well, this one is coming from the delta, and it's actually how it's going to affect the price, if it's going to go upwards or downwards. I know it sounds tricky and complicated, but yeah. For now, I think it's better for you to take the delta and use it as a percentage of being in the profit, and don't worry so much about how it affects the price, because this one we are going to explain it more into details later on in the course, in the advanced part. Sorry. At the same time, we have to take into account theta, which is the time decay, for me at least, and for the type of trades which I'm going to show you later on, but that's going to be for the premium only, the strategies that I'm going to use. Delta and theta are going to be our main tools, which we are going to use, you know, for this. So in general, theta represents, so the time decay typically accelerates as the expiration comes closer, meaning that the shorter options have the highest time decay. At the same time, you have to understand that the price of an option, you can see here, is going to decay the more time has passed. So imagine, for example, at this place, the option costed, I don't know, $20. Well, here is going to cost 0. And here is going to cost 5. And in general, if I'm not mistaken, up to the 30 days, it's going to lose, I believe, 33% of the value, and from the 30 days to 0 is going to lose the other 66% of the value. I'm not entirely sure about this one, but yeah, for example, you can see in this here, let's put theta, and you can see how these values for tomorrow they are going to lose. Sorry. It means the So theta, to resume, is going to tell you how much the option contract's value should change based on 1 day passage of time. So if you have a theta of 0.05, your option price would lose 5 cents per each day of passing, all else being equal. But yeah, of course, you have to understand that all of these values are changing, they are not static. The same happens for delta and for theta and for all the others. Now, speak a little bit about volatility. The volatility measures the relative price fluctuations of a security. It measures the uncertainty, the risk. If you have a low volatility, you will have a less movement, so you will have less risk. Also, if you have a higher volatility, you will have much more movement and you will have a bigger risk. But at the same time, you will have a bigger reward and also a less reward in case of the low volatility. So the volatility, to understand it properly in the analyzed percentage, if we are going to speak about 10% volatility on 100 stock, it means that this stock can either move plus or minus $10 for 1 year. We have no bias for the direction. It can go other ways. So in this case, for example, if you would take interactive brokers, we can see that in this case the volatility, but I believe this is the 30 days, it's of 18%. So no, it's 1 year. So in this case, they are telling us that in the next year, this asset can go pues 450 multiplied by 0.18, either upwards or downwards. So, yeah. Something that we know and we will always know is going to be the historical volatility, but we are never going to go the implied volatility. It's always going to change based on because it's the expected one, which is going to depend on what's going to happen and the factors which are going to come, and so on. So in this case, the historical volatility instead is telling us what actually happened and what actually moved, and it used the actual data, for this one. It's not an estimation like the implied one. So here we can see that, for example, the 30-day, the blue one, it's actually the real volatility which was, while the yellow one is telling us what was the implied. So it's like the broker said, oh, I think it's going to go 25%, but it actually moved only 15%. Now, I'm going to make a small advance, I would say, for the edge. This is actually our edge, because what does it telling you? If you know, pay a lot of attention to the next minute. Based on the look of this graphic, but actually if you will take this, you can see it for the last 30 years, at least, for the SP 500. The realized historical volatility, aka the realized volatility, 80 to 90% of the times it's smaller than the implied volatility. So what does it mean? It means that 80 to 90% of the times the prices of the premiums were higher than they should be. So if you know that the price of an asset is in general priced much more expensive than it's actually happened, it means that as a seller you are going to have all this difference as an edge. So in this case, the difference between the hidden volatility, the historical volatility and implied volatility is going to represent your edge as a seller. Why? Think about it. If you will have a stock market with $100, let me explain you this with a notepad. So we have ABC and have $100 of the stock price, and for this we are going to sell for $2 premium. And to simplify, we take $2 premium because we believe IV is 20%. I'm doing like this to simplify a little bit more. But the AV actually is 10%. So the real premium price should be $1. So what does it mean? If you buy this contract, this call, for example, you would pay $2 instead of $1. But if you sell this call, you would receive $2 instead of $1. So as a seller, you are going to start with this edge. But now, of course, but in the advanced, in the premium lesson, I'm going to explain entirely, you know, how to capitalize on this edge. But you as a seller has much bigger probability and you have of ending, you know, in this profit, but also you are selling it overpriced, you know, so you are not standing from even points, to say like this. Yeah, you can say that there were some times, like for example this period between January and March, when actually he as a buyer would actually save money, or like for example this part here or this part here. But most of the times, 80% of the times plus, I'm going to tell you that you are going to have overpriced price, so it's good to take benefit from them. Like for example, in this case, it would be nice to be buying this option, but in all this scenario, it would be good to be selling this option. So yeah, I hope it makes sense, but if not, don't worry. For those of you which are going to check the advanced lesson and the premium one, I'm going to fully explain this detail there. And then we have, yeah, we also have Vega, Rho, and Gamma, which are the other Greeks, you know, there are, but honestly, they don't represent such huge factors, at least for the strategy that I'm suggesting and I'm showing. So I'm not giving them too much attention, you know. But yeah, if you want to understand, the Vega is going to tell you how much the option contract value should change based on 1% point change in implied volatility. But in this case, unless you are trading months or years type of options, but which in my case I'm not, because I'm recommending to do dailies or weekly expiry options, it's not going to affect us. So I'm going to take a look into it. Now, how to properly plan the trade process. So we have to have a reason for which action we are doing. If we are selling or buying, we have to have a reason, or better said, a prognostic for where do we think the price is going to go. And based on all of that, we are going to have an entry and an exit for the strategy, you know. So for example, it's very important to take a look and realize if there are going to be any earnings, any releases, any drag approval, in case, you know, you are trading stocks or certain stocks, you know, so you have to pay much more attention to this. Then we have the technical events, and we have to take good look at the trends and the support and resistance levels, or fake outs, breakouts, and the fundamentals of the company itself. However, in our case, as I said, I'm mostly trading daily and weekly, so we don't have to care so much about these stuff, but we do have to care about the fundamentals and macroeconomical stuff, because in my case, you know, I recommend a lot to trade the indexes like SPI, QQQ, IWM, XPX, NDX, you know, and so on. Then the position, as I said, it's bullish, it's bearish, it's neutral, you know. Based on all of these, we are going to have different type of strategy. So how about the strike price and the expiration date? Well, in this case, my main factors are theta and delta, you know, for choosing them, of course, together with the support and resistance levels to see if they are close to it. So yeah, and then of course the risk and the reward which you are going to have. We have to understand from the beginning how much we are going to risk and how much we are going to gain, you know, from that strategy. Some key takeaways from the outlook: know what you are trying to trade, consider your risk-reward balance, use the volatility analysis, consider the effect of the time in your strategy, evaluate the strategies with the Greeks, always have an exit strategy prior to entry, and if you have to make changes, go for it, you know. So here we have a small glossary look of the delta, gamma, theta, vega, and rho. So yeah, and of course the premium and volatility. Once again, thank you for watching, and if you have want more details, you can find the website www.traderlife.com. You can also email me at contact@traderlife.com, and you can find me on Telegram at softskills21. So yeah, see you next time with the next lesson. Bye bye.